All right, welcome to the Deal Flow podcast, or welcome back if you're a returning listener. I have a really special guest with us today, and I'm really excited because we have not had anyone to talk about asset management on the podcast before. So with us today, we have Thomas Greer. Thomas is a 15-year a professional in real estate, spanning institutional underwriting, asset management, portfolio strategy, financial modeling, and investor communications. His professional center of gravity sits at the intersection of asset performance, capital decision making, and investor narrative. He is the founder and principal of Deal Frame Advisory, based here in Colorado Springs, Colorado, and he provides institutional grade financial modeling, feasibility support, and capital strategy for developers, private capital partners, and mission-aligned agencies. So, Thomas, thank you so much for joining us today.
Hey, thanks, Michael. I really appreciate it. It's always good to have a conversation with you and be able to talk to your listeners about how asset management, reporting, institutionalization can help their platform, especially as they grow.
Absolutely. Yeah. So I know I gave you a little bit of a little bio there, but in your own words, if you wouldn't mind, just kind of go through your career arc a little bit, where you started, how you got to where you are today, and a little bit about what you're focusing on now.
Sure. Yeah, that's great. So I got my start, my foundation's rooted in private equity real estate, got my start in Pacific Northwest. I've been fortunate to be able to work with some great platforms and some great funds, really spanning the risk return spectrum, everything from core to opportunistic. I worked internationally in Singapore some time, and that's a whole other story, but that was a great experience. I like to say that I've done everything from land deals in China to multifamily in the Sun Belt, right? So right now, what I'm really seeing myself doing is I've been advising some groups that are really scaling and running into bottlenecks as they transition from smaller operators to bigger platforms. So I've been working with them on advising and getting rid of those friction points and really helping them grow. But as far as my background, it really does span everything from all property types, all sectors, and 10 plus years of consulting and bringing and building out Deal Frame.
Awesome. Well, so like you said, you're really focused on advising, growing sponsors through that Deal Frame platform. When a client or a prospect comes to you or you're working on an engagement, what do you find that is usually broken or missing that they don't see themselves?
Sure. It's really fascinating, and I'm glad we're talking about this topic. But when I work with an operator, a lot of my clients, they are really good at executing at the asset level. And a lot of us got our start. A lot of my clients got our start by really starting small and growing big, right? And they start small at the asset level, and there's so much benefit. That's where their skill set lies in kind of optimizing a particular asset. And as they grow, they sometimes keep that mindset. And that's probably the hardest thing with working with with operators, is that they want to grow and they know they need to grow to the next level, but it's how do I get there? And the real reason is because there is a different skill set, if you ask me, between operating at the platform level and operating at the deal level. And kind of changing that mindset and changing how they operate so that they are optimizing for the portfolio as opposed to the asset is usually one of the sticking points. There's a lot of problems and things around that, but when I parachute in, that's probably the biggest thing, is that everyone is still hyper focused on the asset level, and it's a different skill set. It's a different set of tools that's really needed to grow to the platform level.
Okay. Well, then let's just jump right into that. Let's talk about that. What is it? What separates just a bunch of a sponsor who's just got a bunch of deals that they've kind of cobbled together through their their cold start, to the tools they need to be able to think about that from a portfolio perspective,
Sure.
or from a platform perspective, even.
Yeah, definitely. So, like I say, it's a different skill set. And again, what made you successful at the deal level is not necessarily going to make you successful at the platform level. And a big part of that is being able to scale up. So I mentioned how sometimes operators are optimizing for the asset level. Well, you do so because, it's we're all resource constrained, always so amount of assets, capital, human resource, et cetera. You're doing so quite often for a trade-off at optimizing at the portfolio level, right? And you have to ask yourself sometimes, would you rather have an amazing asset at the sake of your portfolio or an amazing portfolio with mediocre assets.
Hmm.
And when you start thinking about and changing that mindset, you realize that certain things need to change. And to get into a little more specific, so like your decisions, right? The way you make decisions, a lot of times at the asset level, you're event driven, right? You're episodic, you're being reactive, which
Hmm.
works because you're a smart person, you have a small team. When something pops up, you can invest 100% of your time and your asset on that. If you're making the same decision 2 times, 3 times, then what you really need is a decision framework. You need a heuristic or a rule of thumb that you can then institutionalize into your reporting or your processes
Hmm.
so that you can then scale that across the portfolio.
Hmm.
And getting operators to do that, everyone says, go recognize that's a smart thing to do, but there's still that trade-off that I find a lot of individuals get stuck on, and that in order to do so may mean there's a trade-off with work on your individual asset, and that's where I see a lot is be able to change into that mindset into more of a decision framework, allowing yourself to create decisions that are repeatable, because repeatable is scalable, right?
Hmm.
It allows for you to take all that institutional knowledge that, a lot of operators have, all that smart guy knowledge, and then be able to institutionalize it, make it repeatable, make it scalable, allow it to be transferred throughout your organization, right? So you don't have that key man risk that a
Hmm.
lot of operators have. When you run to these platforms where they're built by 2, 3 individuals, extremely smart, successful people, it's, well, how do I scale this? You can't scale yourself. Maybe with AI we can, who knows?
Hmm.
But it's hard to scale yourself. And that's where you have to have that knowledge and your skill set that has to be able to transfer within the organization, has to be codified, has to be done. And that's the boring crap, man. That's the reporting, that's the
Hmm.
SOPs, that's the institutionalization of it. I like
Hmm.
to help operators with that. Once you shift that mindset to looking at a portfolio and repeatable processes that scale and focusing on strategy as opposed to asset, then I think you're better aligned to allow for growth.
And so that sounds like there's, the ability to codify process,
Hmm.
SOPs. And then I imagine that also, you talked about there's just a couple people. It also probably has to do with people, right? So you need more people. And I think with emerging sponsors, certainly any company that's growing, there's always this resource constraint that you described, right? Not just time and attention, but there's a dollar,
Yeah.
resource constraint. And so having the ability or willingness to invest in hiring people who may not be driving revenue like on the front end of a deal, but are critical to the day-to-day success of those deals over time. Is that part of it? Like, what do you need so far as team in order to properly asset manage properties, not just get them from your inbox to closing, but yeah, after
Right.
that's done, you might own that asset for a couple of years or a couple decades, and so you need to have a strategy there. What sort of like
Yeah.
people are necessary to kind of institutionalize a business in your opinion?
Sure. So, I mean, it's funny. We work in an industry that, by its very definition, is capital intensive. We understand intrinsically the need in order to invest capital at the front in order to returns on the end. But, you just highlight something that I think is pretty insightful, is that a lot of times you run into a resistance or, a hesitance in order to invest in people or in individuals that may not have that value add until later down the road, or until you start institutionalizing your processes. That's level of sophistication is really what creates that clarity and that confidence that allows for capital to really look at you, right? So there's a
Mhm.
difference between a good platform being an investable platform.
Mhm.
And
Mhm.
as far as the people that are involved, once you've built out your actual infrastructure as a business, your controller and your VP and all that structure, when it comes to asset management and that layer, you need individuals that are managing the assets. And depending upon your structure and whether or not you're completely integrated in your third party oversight, you need individuals that have responsibility for the assets and they're overseeing the plans, the budgets, and the strategy for that asset. How you you slice and dice that up. It can be dependent upon your exact portfolio and whether or not you're working geographically or you have
Hmm.
asset managers that report to a senior asset manager. But you definitely need individuals that execute a plan and create a plan that allows for strategy, for allows for the higher ups and those closer to the asset to do their job. That frees up individuals and principals like yourself so that
Hmm.
you can work more on the less reactive and the more higher level strategy and thinking.
Hmm.
And again, usually that looks like asset managers having ownership 10, 20, 30 years, depending on property type and that sort of thing. And then that gets spread out across the portfolio. So as your portfolio grows, you have more and more individuals that allow for them to manage their own little sub portfolio of assets.
Yeah, yeah. And what do I think that there's property management and there's asset management, right? And they're obviously
Hmm.
very different things. Can you maybe speak to, where is the line between what people are doing, whether or not you're vertically integrated or you're working with a fee manager, you know, what is the responsibility of the property manager or the property management division versus the asset management, division or responsibility? And then where does the construction, sort of sit? That not
Sure,
just the
sure.
day-to-day R&M, but the capital decisions related to making that asset perform in the way that you want it to.
Sure. So, like all things in life, there's a spectrum, right? With that being said, asset management, the goal of asset management is to really translate the data and the operations into performance, into value of the portfolio. At the property level, their goal is to maximize the operations, right? So
Mhm.
if you're looking at it as a spectrum, property management certainly closer to the ground. They're the ones that are trying to enforce those, I would say the cadence of the operations much tighter. They're the ones who are looking at the tenant in the face. They're the ones who are in charge of the day-to-day operations of the particular property. While asset levels bring it up a notch, and they're the ones who are again translating that data that they're receiving from property management into a slower cadence, monthly reporting, maximizing NOI in order to increase value, your quarterly reports, your annual strategy. So it
Mhm.
moves closer up that spectrum to more of the strategic.
Mhm.
And the goal of the asset manager isn't really to manage buildings, in my own viewpoint. It's to manage the property managers,
Mhm.
right? So there has to be that clear responsibility of authority and accountability. And that's usually done through the transfer of information, through communication, through, again, the boring stuff. That's done through reporting, right?
Mhm.
So
Mhm.
ensure that you have that communication layer that's sophisticated, that's institutionalized, that allows for the communication of data between property manager to asset manager to strategy throughout the organization. And that's why this, I speak a lot about communication and reporting, but that's where, you know, the reporting aspect of asset management is so important, especially when you start getting to more strategic asset management.
Mhm.
You can't really improve a system without feedback, without having the data, creating a test, having the data, analyzing that data, seeing what levers you can pull within your asset, your portfolio in order to maximize value. And that data communication is done through monthly reporting, quarter reporting, and
Mhm.
communication with property managers. When it comes to construction and whether it's for development or for large capital projects, that sort of definition and that sort of delineation of authority and accountability is important. Some of that's going to be dependent upon your portfolio, where you're at, and the lines that you draw. But the real aspect that everyone needs to note is that you need to draw those lines. There has to be a delineation. And determining that and communicating that throughout the organization is that layer that we're kind of circling around and kind of we're
Mhm.
talking about. Determining, okay, so what sort of authority am I giving my property managers when it comes to capital decisions?
Mhm.
Am I creating a capital plan as an asset manager that is then being held accountable to? What kind of
Mhm.
KPIs and metrics am I looking at on a quarterly, annual basis to see whether or not I failed
Mhm.
on my the performance of my plan? And, whether or not that looks like something where, anything less than 10,000, they have carte blanche, or whether it looks like anything over 50,000, we need two signers, and whether it means you need the whole organization hovered over a computer, it's an okay button,
Mhm.
whatever that looks like, it needs to be codified because then that's how you improve your process. Because you revisit that next year and you say, or whenever large capital event, there's whatever, a leak or something needs to be done. And you go through your process and you say, you know what? We needed more oversight. Someone needed to be more aware of the ramifications of insurance. Someone
Mhm.
needed to communicate this out to upper levels or stakeholders so that we're getting in front of it. So we're not bringing this up in boardrooms, or maybe the vice versa. This is great, or this is taking too much time from
Mhm.
from my desk, and I need to shift more of that responsibility down. So that's the kind of reactive adjustments that you can make when you start really codifying this stuff and having these plans, but having nothing and just saying, oh crap, there's a problem. I need to think about it. Or, oh, there's a large capital project. So now I need to use my smart guy superpowers and figure it out. That's great at the asset level, but you need frameworks. You need the boring reporting stuff as you start scaling so that you don't have these friction points as you grow.
Yeah. Yeah. I think some of the things that
Hmm.
that kind of we are doing, on the asset tracking level, for instance, is like we really want to get granular on every, line item in the
Yep.
capital budget. If you're, obviously
Hmm.
we develop capital strategy and capital budgets when we do deals, then they have to get translated to reality during the life of the project. We also have to obviously have good checks and balances to ensure that if you're spending money, it's resulting in NOI, right? It's a different
Yep.
lens. Property managers, it's great to spend money to make a unit look great, right? Because
Hmm.
it's easier to lease. That means they can keep it well occupied. There's not as much R&M. So from a property manager's perspective, and this is a little bit why there's like sometimes a little bit of a misalignment of interests
Yeah.
between the site level and the asset management level, is that if an asset, costs $10,000 to renovate that a particular unit, you're only getting $50 more in rent. Well, that's not necessarily a project that we want to roll through the rest of the for the the rest of the
Right. Yeah.
project, right? So we want to know that on a unit by unit basis and say, hey, wait, let's stop the renovations on one bedrooms, or at least let's think about what's going on. Maybe we need to reduce our scope if we're only getting $50 on 10,000, or maybe it can go the other way too. Like, hey, we're getting
Yep.
$300 on a $10,000 scope. Let's go more. It's almost a 40% ROI in 1 year. And hey, maybe we can get that $10,000 cost down to 8,000 and still get $300. And so, how
Yep.
can we optimize that in a way that the property managers aren't necessarily that focused on? There's a lot of times capital budgets, they're not in the P&L,
Right.
right? So
Yeah.
they show up above the line. They don't necessarily always impact site level bonuses, right? The site level bonuses are focused on leasing and NOI and
Yeah.
occupancy. And so sometimes that can lead to site teams over improving. If they're given that, kind of, hey, here's $3 million. We set that budget up front and we're just going to run with it. If you're not checking, as along the way on a granular basis, project by project, unit by unit, you can get into situations where you've overextended yourself, and then you don't have the money for the things you might need later as
Yeah.
well. So yeah.
Yeah. No, 100%. I mean, you hit the nail on the head there. So, every dollar has to increase value, right? And that's the end goal. And
Mhm.
and the way you translate that asset level performance into the higher portfolio and the strategy is by really asking yourself a good exercise that I like to do is, determining what are the values or the decisions that you're making as a higher level strategist for an asset.
Mhm.
And those decisions are really going to be dependent upon certain data and metrics. And are you tracking that data and metrics? And how
Mhm.
are you tracking it? Then let's go ahead and institutionalize that so that now you're reporting on that and you have oversight on the exact data that's actually impacting the decisions that impact the value or the things that you care about. You can see that line go all the way down to the property level, all the way back up of what do I need to know in order to
Mhm.
make the decisions I need. But yeah,
Mhm.
yeah, you hit the nail on the head. And a lot of times there is a misalignment between property managers and the performance of the portfolio, just for
Mhm.
reasons you just said, because their their accountability, their KPIs that they're watching are almost always going to be tied to the P&L, right?
Mhm.
It's going to be
Mhm.
tied to property level performance, and they're more than happy to do overspend if it means that they can show you on a weekly, box score or whatever, that the occupancy is great and look what I'm doing to achieve everything, but they're
Mhm.
using your money to achieve it. And you got to wonder whether or not you want your spend to go to that. Right. So,
Sure. Yeah, yeah.
yeah.
And I think a lot of you talked about the importance of reporting and communication.
Mm,
And I think that's, it starts very much at that, the individual task level that, the systems that we use in our company is we have every
mhm,
asset on the asset management side has a series of daily checks, like daily things, cash, you know, AR, application velocity, like things that
yep.
yes, they're looking at the PM level, but we're also looking at that. It doesn't take us all day to do those things, but spending a little bit of time to make sure that those things are not in the red or the yellow, and then making sure that we have escalation procedures, which again is just a fancy name for communication, right? And reporting.
Yep.
Like, hey, I need to make sure that this information gets to the right place at the right time, so that a decision can be made, right? Because asset management a lot of times is about exception management. And if
Mm,
everything's running well and it's great, that's great. But when it's not, who needs to know about it? When do they need to know about it? And what decision needs to be made as a result of it? I think is something that when you're just coming up and you're just starting, yeah, it is
mhm,
very reactive. You're sort of waiting for something to be on fire, right?
yeah.
And
Yeah.
by the time something's on fire, probably you're not going to be able to do much to. I mean, you can put the fire out, and that's great, but that's not
It's not
always,
optimal.
yeah, it's not
Yeah.
optimal. It's
Yeah.
not necessarily the root cause, right,
Right.
of the fire. So what one living in Colorado, for instance,
Right.
the firefighters of the business, right? Like firefighters in real life, they're putting out the fires, but if Parks and Recreation aren't clearing the brush and they're
Right.
not, coming up with really good procedures and processes and projecting, what the fire season is going to look like and resourcing it properly, then it makes the firefighters, there's more fires to put out, right? So you can do a lot more work upstream, which I think is really a lot what
Mhm.
you're talking about is creating those institutionalized structures and frameworks that allows you to not have to put fires out, right? Get in front of things. So maybe you can
100%.
speak to that a little bit.
Yeah, no. Well, first off, I want to commend you on that use of metaphor. My goodness, good job, good job, and you took that through the whole time. No, 100%. I agree, and really what we're talking about there, as far as escalation goes, that's so important. What you're doing is you're surfacing the risk, and not just the risk, but also the opportunity early. The closer that you're seeing the lead indicators change, whatever that may be,
Mhm,
especially as you, again, that closer to the property, right? You have a more frequent cadence in your reporting. You're
mhm,
looking at details and data and metrics, and whether it be AR, spend, occupancy, you're looking at retention rates, you're looking at this, and you're getting it. We're talking about multifamily. You're getting this, on a weekly basis from your PMs. So you have early lead indicators for trouble, but
mhm,
the data is a bit messy. But the,
mhm,
the more you can set up and institutionalize your reporting so that you determine what you want to look at, you can surface this risk earlier in the process, then you can get in front of it. And the
mhm,
same thing with opportunities, right?
mhm,
As soon as you start seeing that whatever, rent strategy that you implemented, or concession
mhm,
strategy, or even something small, like gifts to
mhm,
tennis, and that kind of strategy. As soon as you start seeing, oh, this works at this asset, or this doesn't work
mhm,
at this asset, the sooner that you get in front of that, you can determine why, and maybe you want to implement it out. And then
mhm,
you start realizing you can start doing victory laps earlier, you can start
mhm,
communicating your wins earlier, and when you start talking to stakeholders, you can work on your messaging better so that you're explaining the reasoning behind your successes.
mhm,
And you really can't do that without the reporting and the boring stuff. And
mhm,
you talked about, so the reporting, asset management, and the reason why I think asset management doesn't get enough, or doesn't get the credit it deserves, is because a lot of this really is that risk management and clearing the brush before
mhm,
the fire gets out of the way. So, when acquisitions or whomever does a good job, investor relations, or you get whatever, does a good job, they're when they hit a ball out of the park, you see it on the positive side. You see it on the plus, and everybody gives them high fives and claps. when asset management, whether it's an individual or just that function, as you starting to do more work and think more of your asset management layer, when asset management does a good job, you're really just preventing a fire. Very rarely. I mean, don't get me wrong. We all add value. We know how cap rates work. And if you can get X amount of increase in NOI through different programs, that's great. And yes, you are adding value. That's the goal, is to maximize value. But a lot of times through asset management, through all this, it's risk aversion, risk mitigation. So yeah, you're ensuring that things like insurance has coverage and there's no lapses, that,
Mhm.
HOAs are being handled and that you're not getting sued and all this and that. Sometimes doing a good job simply means that everything doesn't fall apart and that you're getting in front of this. And you very rarely do you get a high five
Mhm.
for not having the portfolio fall apart. You know what I mean?
Sure.
So it's
Yeah, yeah. That definitely, and I think what it is though, and what it does allow for is when there's fires,
Mhm,
everyone is less distracted, and therefore we can spend more time on growing the business, right? Finding more
100%.
deals, finding more capital, investing more in our people, and bringing more people into the business that can help us grow and make the infrastructure more robust. But when you're dealing with, and obviously we went through this, you know, massive peak in real estate in 2022. And then, we're still in essentially I would call like a multifamily recession in a lot of ways for a lot of operators. And there's a lot of deals that got done in that 21, 22, 23 timeframe, which are on fire. And it's restricted a lot of people from being able to go out and, tell their story because they're
Mhm,
dealing with these problems. And it also makes it very difficult to focus on growth because you're really trying to ring fence and deal with some of these other issues that are serious. You have existing equity. You have to deal with these problems and protect and mitigate the downside as much as you can. And so that can be a real distraction. But if you invest a lot in that asset management, and I would also argue operations at the ground
yeah,
level, you can weather those storms and make sure that you don't have as many fires, right? You're not going to eliminate fires completely and problems. There's always going to be problems, but you just want to make sure you don't have a fire that's going to burn down your house, right? And if you got a house that, that's a problem that,
yep,
that you can't, have. And that's what one of the benefits of asset management as you described it. So switching a little bit or moving from
yeah,
asset management maybe to capital allocation and investor reporting, as a platform scales, individuals who start deal shops and they're doing, their one man or two man ops
mhm,
operations, they get their first few deals done and they're probably doing deal by deal, or maybe they're doing individualized deal JVs. Everything is
right.
different and unique, and that can cause a big mess later, right? It's an administrative burden. It's very difficult to manage. Talk about, what does it look like to institutionalize your capital allocation strategy, and then on the other side of that, the investor reporting.
Sure, sure. So, I mean, the two are very much within my mind interlinked. But as you're moving to a bigger scale, or at least the clients that I've been working with, you start realizing that capital doesn't just allocate. Capital allocates to clarity, and clarity is usually earned, or yeah, it's usually awarded through confidence. So you have to have an understanding of your portfolio, and you have to be able to understand that there is a story behind your portfolio.
Mhm.
I think you just mentioned a time. I think I know we talked about this kind of off camera before, but where you could have done a very good job within multifamily if you started at the appropriate time. We're in a business that's cyclical, that has very large cycles. The real question about whether or not you have durability and whether or not you're institutionalized is whether or not you can weather multiple cycles. And capital understands that. You have to be able to show that your position and that your strategy and the way that you're gaining returns, your alpha strategy, your beta strategy, whatever you're doing, is defensible and justifiable. And you do that by having a clear understanding of how you're making money.
Mhm.
And when you have that level of confidence, that actually ends up being easier to communicate to capital and to stakeholders on the outside. And the way you do that
Mhm.
is by having sophisticated level reporting, having an understanding of what your strategy is. And it's not just, well, I buy assets and then I make them better because I'm a harder worker, or because my value add strategy is I'm simply putting X amount of capital in and then raising rents 20%. You have to be able to show that you're bringing value within a value strategy. You have to be able to say that, look, I'm getting these opportunistic returns on this value add risk strategy because of XYZ, because this is the alpha that I'm bringing to the deal. And the better that you can communicate that you can show that, then it makes capital more confident to allocate to you. And you see that on, individuals are actually doing this right now as they're going back, hat in hand sometimes on some of these refis, is that the other side of the story is not just why you did so good because maybe you're lucky, but also at some point, if you do have a durable platform, a durable portfolio, at some point, you're going to need to go back to capital and you're going to need to say that despite my returns being so bad, this is how I have confidence that it's going to be good in the future.
Mhm.
And all that is just having a justification, having defensible strategy that you believe in, that you understand.
Mhm.
And then that level of confidence will be visible and reward you well with the capital allocation.
Mhm. Yeah, so to speak to that a little
Hmm.
bit, I think, yeah, it is we're in a situation where there are, a lot of operators who either are they had to go back to their investors for capital calls, or if they want to raise more money, they have to figure out how do they explain, the mistakes or the environment in which they had previously done deals, and what has changed, right? They have to be clear about
Hmm.
that because they have to tell that story to new investors. As people are moving from deal by deal and individual smaller opportunities, and they're looking to raise more money, do bigger opportunities. Where do you feel like there is, what type of reporting, what type of messaging is kind of critical as you move through that stage, right? One, for a capital call, right? If you have a
Hmm.
negative situation, what's the best way to differentiate yourself in that
Sure.
scenario? And then, on the other side, when things are going well, how do you go to that next level from deal by deal to maybe discretionary fund or larger allocators that are going to write bigger checks? So those kind of like the two sides of it.
Sure, sure. So, I'll speak from my experience, and before you start thinking, and when I talk to platforms, right, as they start scaling from 1,000 5,000 assets, they start scaling from a capital, in their capital strategy. Before you start moving to that point, you should be doing all of this for yourself. Because again, you have to have clarity and confidence of your reporting and have to understanding of what your portfolio strategy is. So
Mhm.
there's no one miracle report or miracle this or that you're trying to achieve. But what you need to ensure is that you are implementing a strategy that you understand, that the decisions behind that strategy are repeatable, are scalable, that the data that's going into those decisions are something that you have visibility on, and that you're reporting out from that, one source of truth that you're reporting out from that you're able to use that reporting to communicate internally and externally. So that when you're talking to investors, when you're talking to potential capital sources that are outside, that you're showing that one, you have a track record, two, that you have a strategy, and that you're implementing that strategy through a consistent, scalable method that allows for you to have feedback on your platform and improve it. Really, so maybe that's not the best answer for that, but really the goal is when you're talking to capitals that you have to have confidence in your strategy and you have to ensure that what you're doing is clear and confident to yourself.
Mhm.
And then capital allocate to that.
I guess another kind of more
Mhm.
a specific question there would be like, what would be an example of a reporting or investor communication mistake that you typically
Mhm.
see in emerging sponsors make most often that is actually costing them quite a bit and they just don't know about it? Yeah, like,
Sure. Yeah,
go ahead.
yeah, yeah. So I mean, the biggest mistake that I think operators are making is that they're not surfacing and they're not seeing the risk and opportunities early enough. Too often, you're reporting out, whether it's being to investor, to a board, to internally to yourself. You're reporting out, and you're not raising the concern, whether it be a large, could be. Let's just take an example of a large capital allocation that's not coming out early enough within your communications. And a lot of time that's not coming out early enough into the communications with those where it matters is because you're not seeing it until later within the reporting cadence. So the way that you actually just solve for that is by ensuring, again, that the cadence in your reporting is surfaces these risk opportunities early enough within the process and that you're highlighting the drivers of your value. Yeah. So, I mean, really, it's about moving that cadence from the smaller scale to the larger scale. So by the time that you're in front of a board, you have full visibility and you're communicating all those drivers of value that they care about at their appropriate level.
Yeah, yeah.
Mm.
Okay, so let's talk a little bit more. We're almost coming to we got about a little bit more time.
Yeah.
So we'll do one more segment here
Yeah.
on some of the common failure modes and scaling mistakes, right? So you've seen a lot of platforms. Obviously, not all of them make it to the next
Mhm.
phase, that next, from deal by deal to platform. What are some of the most common ways you see emerging platforms break as they scale? What is the failure mode that people don't see coming?
Oh, that's a great question. Yeah. When you start scaling, again, there has to be a mindset shift that you're now maximizing for the portfolio and not for at the asset level, right? So you need to understand and you need to again maximize for the portfolio. So understand that there's going to be a mindset shift from the asset to the portfolio. Yeah, yeah. Sorry, I lost my train of thought there,
No, no.
Michael.
Yeah. So, what is when they don't do that? Like, how does that manifest into failure? Is that they just lose track of what's going on because they just don't have the bandwidth, or how where do you see people
Sure.
not quite making it to the next level? Because most firms don't make it through a cycle or two cycles, and this has certainly been the case with a lot of firms that started in the late 2010s. They
Hmm.
started in a very great part of the cycle, but maybe they were really great at marketing and finding capital, but maybe not so great at actually allocating that capital in a good way. So I'm just trying to, for folks that are listening that are in that sub 1,000 unit range, they want to
Yeah.
scale, they want to be a bigger platform that isn't all reliant on them to do everything. Where do they fail, and what would be your advice to them to make it through and break through that barrier to that
Yeah.
next level?
Sure. So as you scale, decisions matter more than the deals. And that's a bit of a controversial statement, but 100%, you need to ensure that the decisions that you're making align with a scalable, justifiable platform, something that allows for your decisions and your institutional knowledge to be utilized at the larger level. Now, when you think about smaller platforms, think about bigger platforms, right? If you're trying to get to that next level, think about the level of institutionalization that they have, whether it be human resources and capital, in order to change from simple investing in assets to creating a business into a platform, something that can be communicated, something that capital will allocate to. There's a significant layer of real business operations and decision frameworks and institutionalization and reporting that takes place at that asset management level. And in order to fully get to that level, you have to appreciate that and have a plan to get from A to B as you're scaling your company. Again, the thing that made you good or made you money very likely won't be the same skill set that allows you to create a business. When you scale, it's not just 100 U's doing everything.
Mhm.
When you're creating a business, you need to think about the function and the information that's being transferred and the data that's being communicated, and you need to ensure that there's a process and a decision framework that allows for you to take all those wonderful decisions, all the great things that you did at the asset level, at the portfolio level, or at 1,000 units and 2,000 units, and ensure that you can still function at a high level when you start moving to 4,000, 8,000, 10,000 units.
Mhm.
So appreciating that change in mindset, appreciating that in order to scale, it's not just doing what you did harder or with
Mhm.
more people. It's creating out a functional business that allows for there to be economies of scale and a transfer of knowledge that grows above and beyond you so
Mhm.
that you can start doing other things or focusing more on the strategy or vacation to Bahamas or whatever it may be. And you're
Mhm.
still having an operating business with a going concern that's durable.
Yeah. Yeah. So I think that's an interesting, I think it's a good point. I think people think of real estate as maybe different than other businesses, but really when you're building a real estate business or any other business, there's only so much that an individual can produce, right? And
100%.
ultimately you need to, and there's usually a decision that needs to be made around profitability, around what you want long term, and there's a little bit of a sacrifice a lot of times when you're going from a smaller shop, maybe be very profitable because you're not having to bring on additional work, additional labor or systems, and at a certain point that doesn't work anymore, and you do have to make a decision and say, hey, I need to be willing to invest maybe all of my margin to hire people in advance of growth to be able to be successful 3 years from now, for 5 years
Yeah.
from now. And if I want to stay where I am today, then I can do what I'm doing now. But if I want to go somewhere else, yeah, probably I'm going to need to do something that I have not done before or something that I'm not doing right now. And usually that is building out those departments, the understanding, a lot of the best practices, like you said, and making sure you're bringing in leaders who can run business units that can make decisions. You're not just trying to build a whole bunch of helpers because then you just become the bottleneck again, right? So it's how
Yeah.
can
Yeah.
you eliminate or continue to work on your constraints until you're at that next level. So definitely, it's like
You
it's
know,
difficult, but
and
it's necessary. Yeah.
yeah, yeah, so there's this tension that a lot of platforms have too between growth and control, right? Because a lot of individuals want that control. That's what got them to be successful in the first place. But in order to grow, you do need to relinquish some of that control. And you see that, with hires, you see that with controls with processes.
Mhm,
It's can't just fall under that one key man, right?
mhm,
You have to relinquish some of that control in order to allow growth. And there may even be a trade-off. Other individuals, other processes may not execute in particular ways in the same standard that you have. But again, we go back to what we said in the beginning, where would you rather have, an asset that performs A plus in a C plus portfolio, or would you rather have an A plus portfolio with a few C plus assets? So
mhm,
relinquish some of that control to allow for growth and understand that you're building systems, you're building decision frameworks now. You're
mhm,
building a durable portfolio that's more than a particular asset. And then once you start doing that, then I think you're more likely to survive cycles. You're
mhm.
more likely to be able to utilize economies of scale that is so difficult. And as you start reaching those bottlenecks as you grow.
So as we're coming up to the end here, just I
Mhm.
have to always ask question about outlook. So kind of tell me two questions here. One is outlook. We know we're here in the May of 2026, about to go into the summer. The market is, has elevated vacancy. Rents are soft. Transaction volume is not nearly where it was, although it's not in a horrible state. And the supply wave is still working its way through a lot of markets, which means as an operator, things are challenged. And of course, because of all of the deals that were done in 22, I think equity, a lot of LPs are, especially in the retail side, are hesitant to invest in real estate, especially when they're seeing, Nvidia going to the moon and the stock market,
Yeah.
generating 15% returns, every year forever. They're saying, well, why is real estate make sense? Where do you see the market going, between now and the end of the decade? Got your crystal ball. Tell me a little bit about what you think is coming.
Well, I don't have a crystal ball, so I'm always a bit hesitant to
Mhm,
to speak too much towards that. But you're absolutely right. I think with the surprise and the lack of visibility with global tensions with the Treasury. I mean, it's at 4.46 now. I think no one saw a lot of the recent events actually happen. I think there's a lot of uncertainty in the market, and at the global and the macro level, that's being felt with capital and capital allocation, where there's a lot of uncertainty, a lot of unease in where we should be putting capital in the future. I definitely think, speaking more to Colorado and to where I'm located, that we are seeing that supply overhang be worked out, which is good. I think you're seeing slightly more confidence come into the market as finally we're seeing demand to pick up. We're
mhm,
seeing that concessions are starting to be burnt off, which for a while there was a race to the bottom. Everybody was basically trying to survive in
Mhm,
2025, basically concession their way to occupancy.
mhm,
And then on top of that, you're facing this, this debt overhang,
mhm,
and you had a lot of capital debt and a lot of debt that was coming to term. So then you have this kind of perfect storm over the past, 12, 18 months where it was a situation where they saw the rent rolls, they saw that the integrity was low, they saw that the concessions were too high. And no matter what you try to do, you can only fake occupancy for so long
mhm,
before things really start hurting. So you had lenders realizing the situation. Now, granted, I think lenders don't really want a lot of these assets on their books, and there's confidence that they can, extend and bring things out for the next 18 to 24 months. In the future, we're looking forward. We really have to see where that plays out,
mhm,
where the global, the macro ends up
mhm.
influencing everything. But honestly, we'll have to take it day by day and see how the next 12 months go.
Sure.
I think that demand is picking up, and
Mhm.
we should see improvement in valuations. But I think there's just real concern with how these deals are being underwritten and what we're seeing for the future, especially with cap rates being where they are, and nothing's being compressed. You have to underwrite these deals with significant concern on the tail end.
Yeah. Yeah, and I think the beyond that, right, it's,
Hmm.
because there's been very limited rent growth, right? So, yeah, you've had all these concessions. Yeah, the 3-year prior doesn't look so great, but it should, as you burn off concessions, you see is really strong increases in effective rent, right? Because
Hmm.
although that doesn't increase the top line rent, GPR, you obviously are collecting more revenue as that lease turns
Yeah,
over
yeah,
and that concession burns off. And so I think a lot of people are expecting and hoping that in the next 12 to 24 months, since those concessions are burning off, you're not having to give these concessions in this spring season as much. All those concessions that you gave just naturally roll off your books. It drives pretty significant rent revenue growth. And also, we're starting to see because values have come down, you can appeal your taxes, you can bring those down relative to fair value in most jurisdictions. Insurance costs have been dropping a lot. We're seeing 20% year over year
absolutely.
drops in insurance. That certainly helps. Of course, they're double what they were maybe 5 years ago. So you're still working off a higher base, but those are some great relief. I think that payroll, there was a big move
Hmm.
in salaries and kind of labor strength. I think that's started to turn, and I think people are the salaries they're getting are relatively high at this point, and so I think you're starting to see peak there. And so I think a lot of the expense side of the table that has been you've been under pressure as an operator is starting to bring us some relief. Hopefully, we'll see the same relief on the revenue side. But to your point, none of that really matters. If rates go up 150 basis points more, all that goes out the window. And so trying to figure
Yeah.
out, and that's a piece that no one really has, we have no control over that, right? The hope is that we can't forecast or project or underwrite hope. So we have to be conservative. But in the deals that people already have, I think we're really looking for rates to drift down. Hopefully, the conflict in the Middle East settles down, oil comes back down, takes a little pressure off the consumer, should drive rates down. And so that's, I think, what people are expecting through the end of the year. But again, we're always surprised by
Yeah,
what
yeah, yeah.
comes. So whatever we think, it's always something else. So yeah, I really rapid fire questions before we close. So
Wonderful.
what do you think is the most overrated metric in real estate?
I'll tell you what's not the most overrated, and
Sure.
I'll say IRR. I think it's a bad rap, especially among smaller operators, and it's a perfectly fine metric. It
Mhm,
doesn't hide anything. You're not lying. It has everything baked right in.
mhm.
Go ahead and use IRR. It's
There we
perfect.
go. All right. And what would you say is the best piece of advice you received in your career?
It's a people business,
Mhm,
right? Make connections. I have a lot of just recently, for whatever reason, I had a lot of young college grads reach out to me recently and just introducing themselves, saying hi, they're interested in real estate, that sort of thing. I always tell them that's wonderful. I wish I did that more when I was younger, but
mhm,
go out there, connect however you can, shake
mhm,
hands, smile, meet other people, because networks do grow exponentially. And it really doesn't matter. You'd be surprised. I have individuals I went to school with 20 plus years ago, and we're still in conversations, individuals I met in my international travels that I'm still talking to. So I would
Yeah.
say that.
That's a great one. And then I think it's especially important now with, I think people are, it's a lot harder for people to understand how to talk to people, right? I think
Mm,
new grads, I think it's a good skill to, it's going to be the only thing left, right? For us to
there you go.
do is talk to each other because the robots are going to be talking to each other and they're going to be, outperforming us. And so we gotta stick with what we're good at, which is building human to human connection.
That's right.
So, with that, if listeners are just getting started, or maybe they're growing really fast, and they just feel like they're losing the thread on their business, and they need help, or they just want to chat, what's a great way for someone to reach out and talk to you about your business, or just talk about real estate?
Sure, sure. So I'm always available on LinkedIn. So go ahead and look me up on LinkedIn. I'm sure that'll be in the show notes, but
Mhm.
Thomas Greer LinkedIn. Or you can go to my company page, which is
Mhm.
dealframeadvisory.com. Go ahead and use the contact on there. I respond to almost every request, every valid request. Again, whether you're just starting out in the business or you're a seasoned veteran, go ahead and reach out. We'll schedule an introductory call, and I'd love to be able to get to know more about the challenges and the frictions that my clients and others individuals are facing. Let's have a conversation.
Great. All right. Well, thank you so much, Thomas. Appreciate your time. And thank you, listeners, for joining us for another episode of the Deal Flow podcast. We'll see you next time, and have a great rest of your day.
Awesome.